most of you already know me, Steve Burke with Strong Wealth Mortgage. So today we're going to give you a little bit of information on the investment side of owning investment property and real estate. I'm doing the class with Dan Boyd, and I'm going to introduce him a little bit later. He's a good friend of mine and a big part of our class here today. So we're going to jump right in and start with a little humor. So I'll get out of the way here. So existing home costs going up, new construction costs going up, mortgage rates at a 21-year high, and the borrowers were hoping for something with a flat roof. I agree with them. And the Fed today explained the reason they raise interest rates is so that they can lower them again. And that's about what people expect. They don't really know why they increase them or lower them. So I'm going to ask the question here real quick as we get into the presentation. Who here can give me some of the benefits of owning an investment property? And give it to the real estate agents. Anything. What's the advantage of owning a real estate or investment property? Appreciation.
Creates passive income.
Passive income, that's part of it. Anything else? All right, so we'll jump in here.
It's write-offs for high-income people.
Yes, tax savings. So how you get paid with real estate investments as an agent. So well, your client, you don't get paid, but these are the benefits that you share with your clients. Leverage is one of the biggest things in real estate. We know you can buy a $500,000 property. You don't have to pay $500,000 cash. You can put an investment property, you can put 20% down, 100 grand, and finance the rest. So leverage is huge. Appreciation of homes, amortization, these are all, we'll go over here in a second. Cash flow, increasing rents, which is my favorite. Tax benefits for investments, which is what this whole class is about, and another one of my favorites. And then legacy. So those are all benefits. We'll start with real estate's winning record. So many people are scared right now of the current market. Especially Florida, they don't want to buy. Rates are high. They don't want to buy, and then the rate and their home values go down. But this will show you real estate has a pretty darn good winning record over the last 80 some odd years. So 73, 7, and 1. So it goes through 2023. So we've had 73 years of appreciating property values, 7 declining property values, and 1 staying flat. So we know 2024, that's not on here, that went up. 2025 is yet to be determined. It's going to be pretty close, maybe a little bit of appreciation nationwide, and this is nationwide, maybe close to breaking even in 2025. We'll see what happens there. Appreciation, what you said, John, number one, probably the biggest, easiest one to understand. This will show you 4% annual growth, which I think is conservative of late in Florida, and 20 years. So if you bought a $600,000 home, let's say in 2023, in 2043, 20 years later, that home would be worth over $1.3 million. Appreciation, big. Amortization, this is a missed opportunity or a missed benefit that we want to go over. So we put $120,000 down on that $600,000 property. We have a $480,000 loan. Now let's use 2023 as the example. 20 years later, your loan amount is now $251,000. So you've actually paid your equity down, or increased your equity by paying your loan down by over $230,000. Okay, so amortization, every month you make a mortgage payment, you're paying that loan down and increasing your equity. One of my favorites, rent inflation. So when you start off, let's say you start off and you bought that $600,000 property and you're getting $2,800 a month in rent, okay? In 20 years, with 4% annual increase in rents, you could be getting about $6,000 plus a month in rent. Now think about this for a minute. Rent inflation, if you have a mortgage now, a 30-year fixed mortgage, your mortgage principal and interest is going to stay the same for the next 30 years, right? The only thing that'll change, you may have a little bit of an increase in insurance and taxes over time, but your mortgage payment can change. Your mortgage payment may even go down if you refinance. So you're more than doubling your rental income with your mortgage payment taxes and insurance not going up anywhere near that. So 20 years from now, you're making massive, massive monthly income. Make sense? Legacy. So legacy, there's a tax strategy, part of the tax strategy, that if you were to buy a home, let's say for $500,000, and the value went up to $1 million, and you sold it, you're going to pay capital gains on that $500,000 profit, right? But if you took that property, that $500,000 property, it's worth $1 million now, and you left it, you passed away and you left it for your heirs, the heirs would get the property at the $1 million value, right? And if they turned around and sold it for $1 million, they would have no tax liability. So that's what we mean by legacy. You can pass the property on to your heirs and they get it at the current market value. So even if they paid $100,000 and the property's worth $2 million, they don't have to pay $1.9 million in taxes or capital gains. Okay, so legacy is a big one. And before I introduce Dan, so it's not, you can see those individual benefits on an individual basis, but it's the accumulation of all of them working together that makes real estate the best, in my opinion, investment over time. I mean, look at all the benefits, you put those all together, and then Dan's going to talk a little bit about the additional tax benefits that you can, and you can see how real estate, if you explain it and your client understands it, it could be a massive, massive win for them. All right, so what if I told you if you had a smart real estate strategy, you could avoid paying any federal taxes legally? All right, now I'll bring up Dan. He's going to tell you exactly how to do that.
Thank you very much, Steve.
So
I've got some slides about myself, but I like starting with questions instead because you don't want to waste the first opportunity to get people thinking about what you're doing. So how much would you or a client save in taxes if they could deduct or write off 25% of the value of an investment property? So say you got $1 million property. They get to deduct $250,000 from their taxable income this year. How much does that save them? Let's say conservatively they're paying 25% tax rate, right? So that's over $50,000 that they're going to save. So what if you could hand something to your client and say, hey, I know you just bought this investment property, and I know you are a high earner, and I know you don't like paying taxes. You need to talk to this person over here because they're going to help you keep $50,000 or $62,000 in your pocket. Would that be okay with you? They're going to say absolutely. Then what do? You say, hey, now that you have $62,000, that's 20% of like a $300,000 property. They're going to reinvest those savings with you buying another property. That's what we're talking about today. We're talking about ways that you can dramatically, legally reduce what people owe in taxes. So anybody cannot pay taxes. That's just a crime. We help people not owe taxes because that's perfectly legitimate. So how does this work? I'll get to that in a second. A little bit about me. So I work with a company called CSSI that originally stood for Cost Segregation Services Incorporated. We've since expanded our line of services, so now we're known as CSSI. And we are a specialty tax firm that has a national suite of tax services to make sure that people who work with us can maximize their deductions and owe as little as possible legally. We're not CPAs, we work with CPAs so that we can partner with them the same way a radiologist or an orthopedic surgeon partners with a family doctor to provide the best care for patients. So I live in Orlando, I grew up here. Prior to working in the role of tax consulting in this world, I was an educator and I worked in the nonprofit world. I have a lot of hobbies, I collect too many of them and it's hard to get away from them, but I love studying languages, I love fitness, I love photography, and just in general learning, right? If you want to work in schools, you got to like learning. It's a great, kind of a fun surprise when I can bust out fluent or near fluent Spanish in a group. I often get some raised eyebrows with that and it's a lot of fun. Okay, so how do we get to this strategy? So before you understand how that works, you got to understand a couple key components here. So first, what is depreciation? So often we think of depreciation as the opposite of appreciation, which is true, but not in a tax sense. So a car depreciates when you drive it off the lot, right? You buy a new car for $60,000, you drive it off the lot, now it's a $50,000 car, just because you drove it off, and it doesn't have that new car feel to it. That's not the same thing that we're talking about. So I'd say put a box around that idea, set it aside. What we're talking about here is the way that you get the tax deduction or benefit of buying very large assets. So homes, equipment, vehicles, that kind of thing. So how do buildings depreciate? There's two ways. Residential rental depreciates over 27 and a half years, which means that you deduct that property equally over that whole 27 and a half year useful life. A commercial property or a short-term rental has a 39-year useful life. So take that same building value divided by 39. To give you an idea of what that looks like, a building that has $1 million value gets a $25,000 deduction annually. That might sound like a lot, but that's not going to move the needle very much for somebody who's running a business out of $1 million building. Can't it be faster? Yes, it can. How long does carpet last in a rental property? 27 years?
27 years.
No, not 20. Oh, I hope it doesn't last 27 years, right? If you still have 27-year-old carpet in something you're renting, move out, find a better landlord who's not gonna try to have you reuse that nasty carpet. So cost segregation comes from the idea that there's things in a building that wear out faster. It's our job to itemize and give a value to all of that, and then we hand that to you in your CPA, and voila, you get to write off a huge percentage of the building value because those components legitimately wear out faster. So this is, let's say, our working definition of cost segregation, or the idea of segregating or itemizing the costs of a building. So this is an approved method of identifying the value of components in your property that have a shorter useful life. So rather than a 27.5-year useful life, you have a 5 or a 7 or a 15-year useful life. So automatically, you're getting that money faster because you get it over 5 years rather than 27. And then there's some even more fun we're going to have on top of that. So let's look at this home as an example. This is, I would say, somewhat typical numbers we'd see. So assuming the home value, not including land, is $435,000. Then with our work, right, when we itemize that whole building, and we're talking about the drywall, we're talking about the chair rail, the baseboard, the appliances, the heavy grade electrical wire, the shingles, the membrane, the decking, you name it, all of that stuff, we're going to see, okay, in the 5-year, we'll say bucket, right, that 5-year bucket, you might have $55,000. In the 15-year bucket, you might have $102,000. And then the rest of the property, should say 27.5, but that messed up my formatting, so we'll just go with it, right? You've got the remaining structural value of the property, which is $278,000. So right away, you're gonna get this money a whole lot faster. So that means in the first 5 years of owning this building, if you did a cost segregation, you'd be able to deduct $55,000. That's a tax value of about $12,000 over 5 years. And then for the 15-year property, you'll get that much money over 15 years. This money you continue to get over 27 years. So that works out to be about $10,000 a year, give or take. What does this look like kind of numerically in real life? So this property, if you just did what's called straight line or default depreciation, you're gonna get about $16,000 a year every year for 27 and a half years. And again, that's not a lot. That's not gonna move the needle for you. There's a little bit of tax savings there, but not a ton. It's probably about $3,500. By comparison, if you do a cost segregation and you accelerate or push forward a bunch of this money, now in year one, you get a huge deduction, $137,000. So you have a $435,000 house and you got more than 25% of it up front that you get to deduct and write off. So if you showed that much in income, right? Let's say you're an engineer, you buy an investment property, you've got some taxable income, you will not owe taxes on that much of your income. And so now all of a sudden you have a big chunk of change. What can you do with it? You could buy another property. You could renovate your property, right? You can now start charging more rent for it. And so the name of this game is the time value of money. If I give you $1 today, it's worth more than $1 in 27 years. And so if you have clients who plan to hold real estate or stay in real estate for a long time, this accelerates in a dramatic way how much they are going to get back on their investment. Now, you might say, all right, Dan, you said this was 5-year depreciation and 15-year depreciation. What's the deal? So that's true, but now we have something called bonus depreciation. So you may have heard of this from the Big Beautiful Bill. So 100% bonus depreciation was reintroduced. What does that mean? That means that any bucket or category less than 20 years gets to be either partially or completely deducted right away. So if you bought this house today and started renting it out and did a cost segregation, even though you only own it for 30 days out of the entire year, you get to deduct $137,000. Kind of like having a baby, right? If your baby's born on December 31st, you get the deduction for the entire year. So if you're ever in that position where like you got a baby that might stretch into the next year, just schedule an inducement or something, right? Get that sucker out now so you can get the deduction. You won't regret it. You'll notice there's no difference in the total amount of depreciation. So it's just timing. So in 2050, we're all going to be older, right? $10,000 or $15,000 rather is not worth what it is today because of inflation. So get that $5,000 now and every single year and take it up front. So let me pause and take a break. Can I clarify depreciation, cost segregation, anything like that? There's no bad
Can you
question.
go over acceleration one more time?
Yeah, absolutely. So if you straight line depreciate a property, you deduct everything at the same rate. So whether it's really going to last for 5 years or 30 years, you have to depreciate, that means write it off, over 27.5. Your foundation and the carpet are going to be deducted at the same rate. We know that carpet's not going to be there in 27 years. The foundation probably will. So acceleration means we take it out of this 27-year category and correctly classify it as a 5-year asset. So if you bought that same property and you flipped it, you tear the carpet out and throw it away, and you tell your CPA, hey, I spent $3,000 on carpet, they will automatically put that carpet into the 5-year bucket because they know it goes there. The problem is they don't know how to accelerate from this bucket over here to these two because they're not experts in building value, right? They know the tax law, but they don't know, like if they bought this building or you bought this building and said, hey, I have luxury vinyl plank flooring, what's it worth? And say like, I don't know, you should talk to Dan about that. So when I say accelerate, it means to reduce the period of time over which you depreciate and get that money. So any other questions? Go ahead.
We don't want to buy these properties, do the accelerated, and then 3 years later sell it.
Maybe, so we'll get to that. So it's a good question. So that's something called recapture. I have a slide on that I'll get to. You look like you had a question gearing up. Okay, cool. All right. Where's my bonus? Do I have a bonus slide? I might have left the bonus slide out. So here's how bonus depreciation works. Depending on the year you bought and placed in service your property, you get a certain amount of bonus percentage. So from 2018 to 22, you got 100% bonus. And then that started sunsetting every year by 20%. That means it reduced. So in 23, you got 80%. 24, you got 60%. And then for 25, if you were unfortunate enough to buy your property in the first 19 days of the year, you get 40% bonus. Otherwise, you get 100% bonus. So what does that mean? That means, if we go back to our buckets, you bonus depreciate any bucket that's less than 20 years. So if you bought your property in 2024, you'd get 60% of this value up front and 60% of this value up front. So I think that works out to be about $30,000 here and $60,000 here. If you bought it in 23, you get 80% of those same numbers. January 20th of this year, permanently moving forward, 100% bonus is reinstated. So if somebody buys a property that next year, the year after, they will get 100% bonus. As long as there's no change in the tax law, that always happens. But for now, we'll just move forward assuming they're gonna get 100% bonus. And if they change the law in the future, it doesn't change somebody who bought their property in 2025. That property still gets 100% bonus, even if they don't use this service until 2030 or 2040. Why might you not want to do this, or some potentially disqualifying questions? So are you paying taxes? If somebody is paying taxes, they're going to owe less in taxes as a result of doing this. So our fee might be $3,000. Their tax savings is going to be $10 or $20 or $30 or $100,000. So it's almost certainly a positive ROI for them. If they don't owe taxes, I say this is not the year for you to do this because there's no benefit, right? We can only decrease what you owe, but if you don't owe anything, there's nothing we can do. Is your real estate income active or passive? Depending on how that falls, there's a limit, right? If your real estate is passive, you can't use a loss or the depreciation from your real estate to offset your W-2 income. So if you have a dentist who says, you know what, I want to buy a rental home because I have all this money, and so they buy that, but the dentist isn't a real estate professional, his wife isn't a real estate professional, now he can't use the depreciation from his rental home to offset his dental income. So that's not helpful for him. But if he buys an Airbnb, a short-term rental, he can. We'll talk about that. And then are you selling or holding? So you brought up something called depreciation recapture. So you don't own your depreciation. The IRS is letting you use it. Think of it like a loan. As long as you own the property, you get to deduct the depreciation. When you sell that property, you get taxed on all of the depreciation you took. It's called depreciation recapture. So there's a couple ways of thinking about that. And again, I think of it like a loan. So if I give you a loan of $100,000, right? And you know you're gonna give me that 100 grand back in 3 years. And there's no interest, because the IRS doesn't charge you interest on depreciation. How much money can you make by investing that 100 grand for 3 years? Like, what would you think, Malik?
In 3 years?
Yeah.
180.
Okay.
Probably less than 200.
Yeah. So but that'd be an awesome return. So I'd think like 70. So you think you could make 75,000? Let's say you were very conservative, right? You just put this in like something that had an 8% return in stocks or something, right? So now you're getting 8% on that every year for 3 years. I'm not going to do the compounding interest because that's annoying. But that'd be like more than $24,000, right? So at 8%, X 3 years equals more than 24K in taxes, or in investment rather. So now you sell this property in 3 years. The IRS says, hey, you took $100,000 in depreciation out of that. And so, in fact, or rather, let's say you took $100,000 in tax savings. We want that back. Okay, cool, have it back. Do they take what you made off that investment? No, this is yours. You made that money at like no interest, and now you just give back the amount that you borrowed with the depreciation. And so some people will say, oh, I don't want to do it because I don't want to have to pay that back. Well, you're either going to pay this back when you sell the property, right? Or you're going to wait to take that money when at the final sale. I'd rather have that money now and invest it rather than waiting 3 years to get it. So that's the name of the game. The way you determine if this is a break even is you say, what's the cost of doing the cost segregation? Can I make at least, let's say, like maybe I charge $4,000 for this person to do the cost segregation study, or $6,000, right? They're going to make their money back in the first year, and then some, and then some, and then some. So the other thing is, let's go back to the bucket idea. And we're kind of getting into the nitty gritty of this a little bit. These are 5-year components. How long does a 5-year component last? It's a trick question. 5 years. So if the IRS recaptures depreciation on a 5-year component that's 5 years old, there are some CPAs who will do something called diminished value, and in fact all of them will do it, right? But they'll do it at different rates, and they'll say, all right, this property is already 5 years old, so we're going to diminish the value of all of these components, which means your recapture is slashed. Maybe it's not 100K anymore, maybe it's 50K, maybe it's 0. Every CPA treats it a little bit differently. But there's ways to reduce, you could say, the penalty for taking that up front. And the way through any confusion is just do the math. Put the pencil to the paper. So if somebody says, oh, my CPA isn't sure about this, do the math, figure it out. What's your tax savings going to be? How are you going to invest that money over 3, 4, 5 years? Does it make sense? Because it's not about a feeling at that point. It's simply, can you get the ROI you want? Or do you think you can get the ROI you want? If you can, you should do it. If you can't, you should not. Okay. So some common concerns that we hear or hesitations people have, they might say like, well, doesn't my CPA do this? No, because your CPA doesn't know buildings, right? Your CPA has a degree in the tax law, Cost segregation is imagine if a CPA and a civil engineer got married and had a family, their kids would do cost segregation, right? Because they know the building in and out, and they know the tax law in and out. So they know to say, hey, this floor and this baseboard here and the drop ceiling, all of that is in the 5-year bucket. The rest isn't structural. So cost segregation firm specializes in 2 things: tax law around commercial and residential real estate, and building features and building systems and building components so that they can maximize deductions. That's why a CPA doesn't do this. Is this going to trigger an audit? No, simply doesn't. We've done 55,000 studies. We've seen clients get audited below 0.1% of the time. I mean, that's over 23 years. So it's just very rare. And even if a client does get audited, there's nothing wrong with it if you do it right. So the IRS looks at our report and says, okay, you did everything correctly, no issue there. Will a company defend you if they get audited? Absolutely. If they're a reputable company, that should just be a part of what they do. Next one. Somebody might say, hey, my building's too old. Is there any value in doing this? Absolutely. So let's go back to, or maybe I'll kind of chart it out here, right? So if a building is worth $1 million, right? But 37 years later, or 13 years later, so that's half of the useful life of a rental property. They've depreciated half of the building. How much is left?
Half.
Yeah, half. So $500,000. So if they got $1 million building, or even a $500,000 building, if we can get them 25% of that accelerated, does that make sense? To me, yeah, I'd say so. So that'd be a deduction of about $125K on a building that they've already owned for 13 years. So their rent has already increased, right? They're probably cash flowing pretty nicely. Maybe they've paid down some of the debt. They've been able to, their income has gone up, so they're owing more in taxes. Now you're going to hand somebody a deduction of $125,000. So again, if they have that much in income, they owe nothing in taxes. And then people will say kind of funny stuff to it, like, oh, I paid it off already. Doesn't have anything to do with your taxes on it, right? You could buy it free and clear. You could have 7 mortgages on it. It's what did you buy the building for? That's what determines how much you can depreciate. It doesn't matter if the building appraised for twice what it did when you bought it, because it's all about how much did you spend. If you inherit a building from your family, or let's say somebody, a friend is like, hey, I'm sick of this building, I will sign it over to you for $1, right? You can only depreciate $1 because you didn't spend any more than that. The IRS won't let you depreciate more than you spent on the building. And then I'm already depreciating it. That kind of gets to this question. You might already be depreciating it, but there's probably still a lot of money there for you. Even on a building that's $200,000, $250,000, $300,000, there's still a lot of value there that we can identify for people, and it's still going to be a positive ROI. So what does it look like, right? How do you make this happen? It's pretty simple. So we create kind of a 1-page proposal or analysis to say, here's what we think you're going to get in a deduction if you do this, the cost segregation study on this property. And that allows somebody to say, all right, is the juice worth the squeeze? I know what the fee is. I know what my deduction is going to be. Should I do it? And if they say yes, we send a photographer out to take pictures of the property. Those pictures go back to our engineers. The engineers look at everything and figure out, okay, what's the drywall and the tax and the drop ceiling worth? That's our report writing. And then we hand that over, and there's really just, it's kind of almost like deceptively simple. Steve could tell you, like, here's 3 pages. Hand this to your CPA. They'll know what to do with it. And that's all it is. So we can wrap that up in as little as 2 weeks, usually about 2 to 4 weeks. And so even if somebody wants to do this before the end of the year, like, there's still time to get it in. You don't have to do it before the end of 2025. You just have to do it before you file taxes. So I'd say as you're thinking through kind of the list of, all right, who did I sell a house to, or who bought a house that worked with me who'd be a good fit for this? Anybody who bought an investment property this year, if they closed really any property, but especially if they closed after January 19, if it's worth at least $200,000, and if you know they're going to hold on to it for a little while, then they're a good candidate. And just say, hey, I think you should look into this. There's no, you don't have to pay anything to figure out what's the value of this. But just take the opportunity and learn. There was I think the opening thing you had, or the opening quote you had, People are wealthy not because they have money, but because they have information.
Yep.
And this is very valuable information. And probably the most common question that I get when I start telling somebody about this is, why did my CPA never tell me about this? And there's just too much to know. If you go to your family doctor and they don't detect that you have a heart murmur, but then you show up to your cardiologist and they're like, hey, you got something weird going on there. Why did the family doctor not catch it? Because they're not a specialist. You go to a specialist when you have a special need. And when you start to get into high net worth and investing in real estate, that's a special need. And it's worth it to pay to work with a specialist. I think people will realize that time and time again. Yes?
Would we be able to use this for a property such as mobile homes, condos, townhomes? As well?
Yeah, anything. If people make money with real estate, they can use cost segregation. There are some scenarios where they might not need it, they could still get the same benefit. And if we identify that, we'll just explain it and say, hey, you don't need to pay for the service because you can easily apply it. I just worked with somebody who bought a mobile home park. 100%, virtually it was 99% of what he bought was in the 5-year and the 15-year bucket. So he got over $1 million deduction. He spent a little over $1 million and got $1 million deduction. You guys not going to owe taxes forever, right? I did a golf course, and this is such a fun story. It was a $3 million golf course. They got about a $2.7 million deduction in the first year because the greens, the tee boxes, the cart paths, the landscaping, the parking lot, the lighting, you name it, all of that got accelerated. And if people don't know about it, right, this is kind of like getting a will done, right? Just, folks may have heard about it, but they put it off because they're like, I'll get to it later. And then when they do it, they think, I wish I would have done that so much sooner, right? It's just that, or getting dental work done, right? You can put up with kind of like annoying tooth pain for a little while, and then all of a sudden you get this big tax bill. You're like, I need to get on this right now. So we get a lot of phone calls this time of year from folks who say like, I should have done this 3 years ago, but now's the time. So I think you've got the next one, Steve, right?
I'll jump back in. Thanks, Dan.
You bet.
Good job.
Thank you.
All right, before I get into these qualifications to go over a little more detail, I want to piggyback back on the recapture part. Remember when I mentioned the word legacy? And you can hear it? If you actually pass the property on to your heirs, all that recapture is gone. It's wiped out. Doesn't matter. They don't look at it anymore. Your heirs get the property at the current market value, okay? So that's one thing, keep that in mind. The other thing, and this, you would keep this to your tax professional, whoever you use from a tax standpoint, you could continue to defer the depreciation or the tax liability through like a 1031 exchange. So, but there are some nuances to it that you have to understand. So there are ways to get around that a little bit. But again, the legacy part is just, I think, is huge. So if you own that, pass it to your heirs, everything's wiped out. They get the property at market value. And before I get into this, Dan mentioned, Dan actually did a cost segregation for me personally. I know a lot of you know me personally. Jen and I, my wife and I, actually purchased a property earlier this year as a short-term rental to use as a case study for all of this, because I believe in teaching other people about building wealth through real estate, and I think that what we've talked about here today is one of the biggest advantages. So you'll start seeing a lot of clips. Raphael and Malik will be getting a lot of clips out and things on my story on how we did it. And he did Dan's team did the cost segregation. So when I do my taxes for 2025, I'm looking to save about $50,000 in taxes, 50 grand about. So good stuff. To me, that was well worth it. So that's almost half of my down payment on the property getting back. All right, so let's talk about it. So not everybody can do the accelerated depreciation. You have to qualify, but there's ways to work around a lot of these things. Part one, if you're a real estate professional, so if you have a real estate license and this is what you do all of your time, you're in pretty good shape. You're qualified as a real estate professional for the year if you meet both the following requirements. More than half of the personal services you perform in all trades or businesses during the tax year were performed in real property trades and businesses which you materially participate, or you perform more than 750 hours of services during the tax year in real property trades or businesses which you materially participated. Now, you can still use cost segregation or accelerated depreciation if you're not a licensed real estate professional. You just have to meet the hours. You have to spend a significant amount of time doing and materially participating in real estate. If you have the real estate license, that usually will qualify you to do it.
How
So
do they verify the 750 hours?
you'll have to keep track of it. It's like for me, for the short-term rental side, I actually have a calendar log. I was this many hours, I just keep the calendar, I put in this many hours researching supplies and
So
all
here,
this
it's
stuff.
on
So
you.
I keep it, it's on you. Yep. I know friends that do this, and I'm a mortgage professional. I'm not considered a real estate professional, so I would not be able to qualify for this side. But I could have Jen, my wife, be a real estate professional or get a real estate license and materially participate in this or share it, and then I would qualify for this. This way you can qualify for any type of accelerated depreciation through an investment property, long-term, short-term, commercial, all those different types if you're a real estate professional.
Actually, something you said, Jen, but what if one of your kids had a real estate license?
But you're not gonna be
No, I understand. I
doing the
just wanted
tax
to
return
use that.
jointly. Yeah, you'd have to. That's a good question though. If they're dependent still on your thing, that would be a CPA question. But
Aren't you a CPA?
I don't practice. I just have the license. Okay, so this is the loophole for everybody. Short-term rentals. So you can use the accelerated depreciation if you buy a property that you rent on a short-term basis. So material participation tests, there's 3 different avenues. You participate in the activity more than 500 hours. That can be kind of tough. Your participation was substantially all the participation in the activity for the tax year, including all individuals who didn't have any interest in the activity. That means you did all of the work more than your property manager, anybody else that's involved in the property. That's a tough one. The next one is the easiest one to do, and that's what I'm doing. You participated in the activity for more than 100 hours during the tax year, and you participated at least as much as any other individual, including individuals who didn't own any interest in the property. Okay, so I bought this in the first two and a half months. I logged over 100. So that's the way to do it. So if you have clients that may not qualify as a real estate tax professional and you're teaching them about investing in real estate, the short-term rental would be the way to use the accelerated depreciation. Make sense?
Yes.
Okay, and you've got these in your packet, so if you need to refer back to it. And then again, I defer to your CPA to get information on this. And then back what Dan was saying, you need a specialized CPA. Not all CPAs do this. I'd say probably about, of the CPAs that I've talked to, about 80% don't. And they're not familiar with it. They don't do it with their clients. So you have to find the right CPA that you're going to work with here. And again, you get the packet from Dan's team, and they basically have to put it in there, but they have to understand the process and things like that, and also plan for you for the future. So the right CPA that understands this tax strategy and do it is worth their money in gold. So, any other questions? Good. We ready to go out and take advantage of the benefits of real estate investing, or teach our clients, right?
It's very helpful.
All right.
That's good. Real good.
All right. Thanks, Dan.
You bet, yeah.
Thanks, guys.